What's up guys, TJ here with Millennial Mortgage. What I'm going to talk to you about today has been on everybody's minds because it's the end of the year, it's taxes. Specifically tax write-offs. And if you're like me and you're self-employed, this is a huge subject with saving money and planning for your financial future. So today we're actually going to talk about how tax write-offs can potentially hurt you in the long run. Typically what we see is when a self-employed person finishes out a year, they want to pay the least amount of taxes possible and will write off business expenses, cars, anything that they can possibly write off to minimize what's called their tax liability. Obviously, quick disclaimer, this is not tax advice. I'm going to be talking to you about the impact it has on qualifying for a loan, but if you want tax advice on how aggressive to be with your taxes, what to do, please contact your CPA. This is for entertainment purposes only. So here's the deal with tax write-offs in general. I'm going to use an example. Let's say that this last year in self-employed income, you made $100,000. We're going to use super simple numbers because it's really easy. So $100,000, and let's say you're going to owe $20,000 in taxes. Now, typically what will happen is either you'll use an S-corp or tax write-offs to minimize your taxable income. Okay, so if I only show the government that I'm making $20,000, then I'm not gonna owe $20,000 in taxes. I'm gonna owe $1,000 to $2,000 in taxes. Here's the problem with that. Is when you come to somebody like me and you want to buy a house, I'm also only going to see that $20,000 of income. You can't use that if it's all written off. And so it's gonna be virtually impossible to get you inside a house without using a non-qualified mortgage product, which will raise the rates pretty significantly. Remember that when you're qualifying for a mortgage, there's a few things to keep in mind. Your down payment, your debt to income ratio, and your credit are huge. This is gonna mostly impact your debt to income ratio. Maybe your down payment as well, if you can get out of some taxes. Now, one of my favorite tax strategies that I'm aware of is depreciation. Depreciation is awesome because when you depreciate an asset, as a tax write-off, it's a little bit different, whereas when you come to a lender, when you come to me, we can add that depreciation back into your income when qualifying for a mortgage. Now, again, if you want advice on how to do that and what exactly it is, talk to your CPA, not me. But the moral of the story here is to always be very smart with how you do your taxes and how you set up yourself for financial success. If you are interested in meeting one-on-one with me and going over some mortgage planning and getting you into your first home, getting you into a refinance, or even just moving homes, then please shoot me a message. Click the link in my website and we can schedule a 30-minute consultation. Those are free. As always, it's a pleasure and thanks for tuning in.